Is now starting. All attendees are in listen-only mode.
Hello, everyone. This is Chris. It's February the 5th. I hope you had a wonderful Super Bowl weekend and also had a wonderful January. It's hard to believe how quickly, to me, it seems like these Connect series once a month, the beginning of the month, webinars come around. Time seems to fly. Today we're going to be having a little shorter webinar because we're just trying to kind of hit one certain type of theme. So let's go ahead and get started here. And just as a reminder, the Power of the Pattern is your 30-second investment solution. We want to share some ideas, some visual solutions that you can see what is done, why we feel that way, where the stop loss protection is, and how to take action and not consume a ton of your life. As a reminder that we do every month, we're not a bullish or bearish shop. We believe that bullish or being bearish is nothing more than a psychological state of mind, but we are bullish on opportunities, and I continue to see many opportunities, and I believe, again, 2019 will be an exciting year for many different opportunities. You know, as I start out the year, I kind of think about the last two webinars, and this image kind of came to mind. If you think about roughly 35, 40 days ago at the first of the year, what were people saying about the month of December? Anything come to mind to you? Well, the first thing that jumps out to me is there was a lot of analogies. Oh, I mean, it was a fact that it was the worst December since 1932, and then people were trying to make parallels to the Depression and how bad it was. And Mr. Market's job, I believe, the name is Grantham. No, not Grantham. Excuse me, but the name is slipping. Who came up with the idea that Mr. Market's job is to fool the majority of Benjamin Graham? Excuse me, is to fool the majority of the people, and in some ways it did. And then what is the statistic about December or January that we just wrapped up? That January was the best January since 1987. So there was a lot of movement taking place. When we look back 2 webinars to the beginning of December, our major theme was that there was still bearish extremes in play. It was easy to find people cocky in the markets. It was easy. Dumb money had been very, very bullish. Many sentiment indicators were at bearish extremes. And then roll it forward to our last webinar, which was in the first part of January. Then we highlighted how many bullish extremes were in play. The dumb money percentage was virtually sitting at 0. The dumb money indicator was just extremely scared to levels seldom seen. And so it's not as surprising to see December being rough to the downside, and then to see January be up to a good degree after we saw such extremes 30 days ago. This graph is the net return of several key indices in the upper right hand of the chart for the last 2 months. And you can see that the net return, the top one for the NASDAQ is a negative 0.85, then the New York Stock Exchange down 156, mid caps 184, small caps 185, the Dow 201, and the S&P 2.10. And so if any of you are triple play members, when we started seeing some of these extremes, and at the end of January, we were watching long-term rising support to see if it would break, to try to suggest that if you've got long-term holdings that you need to be looking at pulling them off the table. But with those type of extremes that were in play, it just didn't seem like that was good advice. And so for those that panicked at the bottom and sold out, this has probably been a frustrating January. For those that hung on, it's just been a heck of a ride that essentially has been about almost a net neutral situation over the last 60 days. And it's kind of speaking of panics, that the majority of people, Mr. Market fooled the majority of people again. This is a picture of equity flows in and out of equity funds or stock funds over, folks, about 35 years. And you can see in the lower right that despite, the market falling collectively from 2000 to the '03 low, the S&P falling nearly 50%, and then the financial crisis falling nearly 50%, the nearly 20% decline that the S&P experienced from the September 21st weekly closing high to the December 21st weekly closing low was, less than 20%. You can see from this chart, there was a ton of panic, that took place as far as in a short-term time period. It was the greatest outflow of funds in a few decades. So we did see some extremes and a lot of panic. So it doesn't surprise me to see the kind of January that we had, coming off of that kind of panic. And I saw this quote, ironically, everyone, it was from Men's Health, but I thought it really applied to a lot of people's mindsets. It says the whole problem with the world is that fools and fanatics are always so certain of themselves, and wiser people are so full of doubts. And as I read that, I thought back on, my friend and mentor, Sir John Templeton, that, I'm no Sir John Templeton, and I'm no brilliant person, anything close, to him. But I thought the thing that was really interesting about Sir John is, despite being a multi-billionaire, having one of the best track records in the world, he just remained so grounded and humbled. And I think some of it had to do with, after decades of experience, you just kind of realize that this isn't an easy game, and that the majority will be fooled the majority of the time. And so today's, Connect Series webinar is going to try to look at, this question, or kind of address this question or issue is, with the 9-year rising support still in play, when we look at lows from '09 and '10, and we've seen in many of the major indices a series of what, higher lows, and higher lows for years. And when we saw the decline into around, let's just call it, Christmas Eve, these 9-year support lines were tagged, but they weren't broken. And so is the question to me, and I want to try to help educate and empower, the question will still be unresolved at the end of this webinar. I don't want to say that I'm going to know the exact answer, because I don't, but I want to give you some clues of things that we ought to look for to help resolve this question. Is the decline behind us, or is this just a rally in a new downtrend? So we're going to kind of, today's entire reduced webinar is going to kind of try to address some of these things. So for almost 2 years, we've indicated that we thought the very emotional highs and lows of the 2007 high and the 2009 lows were going to be important in the future on a rally based upon Fibonacci extension levels. So well before they were hit last year, we tried to share what these targets in the sand would be, and that until broken, in our opinion, they would be 800-pound gorillas, and they would most likely, be hit from the underside, and then at the best case, a base would be built underneath it. At the worst case, they would become topping patterns. So each of the red arrows represent key Fibonacci extension levels. The left chart's the Dow, the middle is the S&P, and then even a bigger, longer-term extension level is we applied Fibonacci to the 2000 high. This is the QQQ, the NASDAQ 100 ETF. We applied it to the the closing high in 2000 and the closing low in 2003. So the 161 extension level of the 2000 high and the '03 low came into play this last year. And pretty much, the Qs came up there and banged their head, right on that key extension level and reversed. But to me, the main thing is these blue lines. These are blue rising support lines. This is a solid uptrend that's been in place now for 9 years, 9 to 10 years. And as I just said earlier, each of these lines were tagged, and that's where some reversals took place, and that's where the outflows were the greatest in 30-some years. So despite some damage being taken place, if you look back, each time that this resistance or rising support line, excuse me, was formed, there were declines that took place. It shook a lot of the scared hands out, caused dumb money to become very concerned, and smart money to become actually very aggressive, and see the optimism, pessimism spread and indicators reach certain levels where typically lows took place. So the thing that I see, right now is the 800-pound resistance levels are still there with the Fibonacci extension, and also the very, very strong 9 to 10-year rising supports are still in place. So we find ourselves in the middle ground between heavy support and heavy resistance, excuse me, and strong support. The one thing I want to remind everyone of is that we're speaking of extension levels. Is let's go back in time, but we use the same dates, the 2007 high and the 2009 low. This is looking at the S&P 500, and the thing I want to remind people of that we've talked about many times, but we appreciate the new members that have come on, and for those that don't recall, I just kind of want to go back and re-look at this. But this was the 161 level based upon the 07 high and 09 lows, and you'll see that the S&P, when it came up and hit this, it essentially, what did it do? It formed an upper level base to push higher off of, but it took time. So the 161 extension level was resistance. It struggled trying to get above this. It banged on it several times for almost 2 years. Even during the process, you could see that it created lower lows. And then when it came up and broke above it, almost an ideal technical pattern took place, is that it broke above the 161 level and then came back down, and for the first time in history tested old resistance as new support, and then the S&P rallied 50% in around a year's time frame. So the one thing that we tried to empower people on, it didn't mean it was going to be true. I went out on a limb a year ago and said, folks, look for this to be a sideways year, choppy price action, capital preservation would be important, keeps trades small. Don't be surprised that very few upward gains take place. And as we've highlighted, recently, I think it was over 90% of assets in the calendar year 2018 underperformed cash. So it wasn't a terrible year on net return for most assets, but it was a year that portfolio allocation didn't help people much, and hiding in the sand, just kind of owning cash was actually one of the better places because you gained capital preservation. So again, the 161 level caused the market to chop sideways and frustrate people for nearly 2 years. So as the S&P came very close to the 261 level in January, February of last year, we're seeing a similar type of price action take place. In other words, a sideways chop. So as today that I want to try to help answer the question is, with long-term support still in play, the long-term trend is still up, but we want to look for clues of what would be a positive that the S&P can rally back to the top of the trading range to the 261 level, and then also what to watch for as far as where reversals could take place. And so I don't think I've ever seen, this week is my 39th anniversary in this business, and as I shared last year at this time 1 year ago, I don't think I'd ever seen, and it didn't matter how long you'd been in the business, because this is all hindsight, folks, I'd never seen so many Fibonacci levels that could be resistance coming into play at the same time. And so, as last year was, I think it was quirky. It's not totally uncommon, but I'd never seen it. But, what were the chances, everyone, that the weekly closing high in the S&P last year took place on the first day of fall, and the weekly closing low for the 2018 year took place on the first day of winter? So there's really some seasonal patterns, and Fibonacci seems to have kind of a grip. There's nothing bad about it. I think it's actually good if we can recognize that those tools are really excelling. That's where we want to lean on them even a little bit heavier. So the rally off of those dates that I just mentioned, the September high and December low, the S&P, this is a monthly chart, is back at the 50% level. So we're halfway there from the high to the low. And so with Fibonacci being important, obviously the halfway point or the 50% retracement level is going to be really key. And so a positive for the long-term bull trend would see the S&P being able to push above the 50% level, because you can see it actually, this was a low at one time, last fall. And so right now we're at 2, we're testing a key fib level that if it could break above it, look for more dollars to flow in and higher prices for the S&P. So not only is the S&P testing a key Fibonacci level, one of the things that we tried to tip you off and empower you with that the market could struggle for calendar year 2018 was the different bearish divergences that were taking place in the banking index, home builders, and junk bonds. And so this looks at 2 different banking indexes. On the left is the KBE Bank ETF, but it's an equal weight. And then on the right is the BKX, the bank index that's more cap weight. And even though it's called the bank index, if you lift up the hood, there's actually quite a few insurance companies in there. So if I'm to favor one of these 2 that mean more to me, and probably it's the one on the left, which is the KBE, which to my understanding is purely all bank stocks, and then it's not being distorted by size. So as the S&P is tracing the 50% level, both of these, when you take the high of the entire year 2018 and the low of 2018, both of them are at the 50% retracement level. So again, this is again, bearish divergences have come from this key index. They are quite a ways from their highs of last year. Both of them, I believe, just from a rounding potential, are 15 to 20% still below those levels. And so since a negative divergence was taking place in the banking index and they're at the 50% level, this is really key that if this is to be something more than a counter trend rally in a new bear trend, definitely want to see the banks take out the 50% retracement level. One of the things that's positive that's taking place, right now that we share every week in the global dashboards is the price action or the message coming from the advanced decline line. So the advanced decline line, to me, started creating a bearish divergence around Christmas. And why do I say, I said a bearish divergence, I meant a bullish divergence. And what to me appears to be a bullish divergence is that I tried to share for months that one of the key things that we wanted to see for the bull trend to have a chance to remain intact is that the AD line did not take out the February lows. It actually lagged on the downside through the year, which was a positive. In other words, it didn't fall quite as much as the broad market. And then when things really started falling apart, it did not surpass and break down below the February lows, while the Dow did, the S&P did, mid-caps did, the Russell did, the Wilshire 5000 index did, the NYSE did. It was just all across the board. The February lows were taken out in the popular and large indices, but this didn't break down. So this was a short-term positive divergence, which ended up being maybe a tell to what kind of January, or just that we could have a positive January take place. So support was hit at 1, which was a positive, and then a rally is taking place. And if you'll notice, the NYSE advanced decline line is now nearing the highs that took place last summer. So the message to me to watch for here would be if this is more than a counter trend rally, if the NYSE AD line breaks out above last summer's high, it would lower the odds that this is a counter trend rally. This is something that's positive. One of the things that you might have seen is I'm seeing published out there, and it's all true, the AD line on the S&P itself is at new all-time highs. It surpassed last year. And so that's in itself is a positive. I'm a fan more of watching this, the AD line on the NYSE, because you know, the S&P, as we all know, is 500 issues. The NYSE, forgive me, but I believe is around 2,500. So we have, you know, like 5 times as many issues to observe in this index. But a bullish divergence is taking place, you know, which is a positive for the uptrend from the NYSE. Another index that we tipped off last year and we shared month after month in the global dashboards and in sectors reports from time to time was the bearish divergence taking place in home builders. And home builders started falling apart in 2005 and 6, well ahead of the broad market before the financial crisis got started. And so they were the canary in a coal mine, one of them in 2007. Banks did the same thing. They were a canary before the financial crisis got started. And so I wanted to share that, man, it looks like a really important test is taking place in these home builders. You know, they started a bearish divergence in January at the highs, and then they continued and accelerated the bearish divergence. You can see at the September highs. So they formed a new falling channel that's taken place in the calendar year 2018. And you see a double test at the very bottom of this falling channel. But now the counter trend rally is testing, to me, 2 highly critical and important inflection points for home builders right now, you know, which is XHB. So home builders are testing the falling channel. That this would be the last place that the long-term bull trend would want to see home builders run out of steam. If they would, and they'd start falling at this price point, it would increase the likelihood that we're experiencing a counter trend rally in a new declining trend. And so also the lows you could see over here of 2017 are now being tested as resistance. We have a dual inflection point with momentum as overbought as 1 year ago in the upper part of this chart. So I do believe that we've continued to see highly important messages from home builders, and what home builders do here, folks, I believe will send us another important message to answering, are we going to continue this long-term trend, or is this nothing more than a counter trend rally? So one of the patterns that as I look at this, and I shared it, if you're a sectors member, if you got to read the report that we shipped out early this morning, this is what what would come to mind is low odds, high impact. So let me just get it off my chest. I think there's a low odds of this pattern read being true. But if it happens to be, you better know about it because the impact could be high. So this is the QQQ, the NASDAQ ETF, as you all know. And this is on a weekly basis. And so the point being is there's a possibility, albeit low, that the Qs are making a head and shoulders topping pattern. And the thing that you know, is I don't know that there's ever, folks, an ideal head and shoulders pattern. You know, ideally, you don't want to see the right shoulder go above the left shoulder. But in 39 years, I've seen it happen and the pattern still be true. I've seen, you know, the neckline not be horizontal and the pattern still be true. But one of the things that technicians like to look for is symmetry in time as well as price. So if this pattern would be correct, the right shoulder, or where the NASDAQ is currently, is below currently than the left shoulder highs. That one of the things that interested me is if you look at the time it took to form from the weekly closing high of possibly the left shoulder to the head, I just did a highlight in the green of that time window. And then I did a copy paste just so we could measure time on the downside. And that's what I colored in the pink or light red shading. So you can see that there's 2 pieces that potentially fit. The right shoulder, if it happens to be, is still below the left shoulder. And from a time perspective, the right side, or the right shoulder from the head to where we are now, is taken about the same length of time as the left shoulder to form. So still nothing proven, but this could go a real long way to proving that this is nothing more than a counter trend rally if we would see techs start selling off heavily at point number 1. So again, folks, possible pattern, but again, as I just started this with, low odds, high impact. Low odds of this being true. If it is true, it's really a large impactful pattern, because you would, the measured move, you'd take the head to the neckline, which is roughly from what, 190 everyone to 150, and then you'd say, well, if it would break the neckline, which that's even if it reverses here, the next big key is, will it break the neckline with a close around, let's call it 145. But if it would break below that, the distance from the head to the bottom of the right shoulder at the neckline is around 40 points. And so this is why I say it could really be ugly if this pattern would be true, because the pattern would suggest from a measured move perspective that a break of the neckline, around 140 would take it to around 100, which, is a large percentage. It's off the chart. So nothing proven here, but I want to make you aware that this could be a really important pattern that's near completion. So, and what would it take to blow this pattern out of the market? Say, hey, Chris, you just wasted my time. It would be, one of the first things is a rally above the left shoulder highs, so that would be something that would just tend to eliminate this possibility. Possibly, though, folks, a very important pattern. So we're going to switch a little bit just to, we started off the webinar with the person with the neck brace on. Just kind of want to share some real sentiment extremes that took place. Back in September, I shared that the high of the year took place from a weekly closing basis on the first day of fall, back here in September, on September 21st. You can see this is the spread between indicators showing excess optimism to pessimism. And when it's lofty, markets are typically closer to highs, and when it's low, markets are typically lower, closer to buy points or lows in the marketplace. So here was last fall, and then here was essentially around Christmas. So when we did the last webinar in the early part of January, we highlighted that this thing was way overbought, and if you're a short-term trader, you ought to be looking for, not be shorting, and then be looking for opportunities to the upside. Excuse me. So the last 30 days has seen this indicator do another flip. You can see now the black arrow that the spread is back into barely above the level of excessive optimism. And so again, that's what to me makes the rally at these Fibonacci 50% retracement points where we are all the more important, because now some indicators are going from oversold to nearly overbought in just a 30-day period. So looking at smart money, dumb money, again, at the last fall's high, this indicator was at a very low point, which that's where markets are typically closer to a high. And then you can see a month ago at the January lows, the indicator was at one of the highest levels in the past several years. And that's where we saw the January rally start to unfold. Well, now another big shift has taken place in 30 days. The best January since '87 has now flipped this indicator to not be at crazy extremes, but it is getting near the level of excess pessimism, or in other words, oftentimes markets are closer to highs than lows. To me, if you look back, folks, this indicator is better at bottoms than it is at tops, but we do have to recognize where this indicator stands at current levels. So this is a closer look at just smart money, dumb money that I think is interesting. Let's look back. The red line is dumb money. This was a year ago. This is when we started sharing that we thought stocks would struggle for months and months because there was just it was so easy to find bulls, hard to find bears. Optimism, cockiness, you named it, was taking place at when the 261 level was being hit back in January. So I want you to just kind of keep your eye on this. Was the highest confident level of dumb money over the last year. So now you can see where dumb money is. And so The only time in the last year dumb money felt more confident was at the January highs of 2018. So you can see where we were in the webinar 30 days ago. There was hardly, the dumb money was just shaking in their boots, and the smart money was very confident. And this gray line is the S&P. So you can see as smart money was confident here, it was high, and dumb money was low. That's where the market low took in place. So we're now seeing a crossover of excess confidence in dumb money, and smart money is now getting concerned at current prices. So another thing that I want to share is, each week in the sectors report, we share the CNN fear and greed proxy. The great service Sentiment Trader, if you're not a subscriber, I'd encourage you to. I've been a subscriber for, it could be 10 years now, but I love their service, and it's of a great value. They do their own calculations, and so if you'll notice at the top it says CNN fear greed proxy. So it's their best attempt to replicate what that index is. And so the numbers, if you lay them side by side, folks, are not exactly the same. Doesn't make one better or worse, but I want to just kind of bring up an interesting point that they were sharing. So you can see a year ago when we said we thought the market was very lofty where the fear greed index was. Then close to last fall, it got cocky again. Here's 30 days ago. Excuse me. There was tons of fear, excess fear was taking place, in the market, and that's where the rally took place. But you'll now see that a really sharp rally has taken place in the fear greed index. So I want to share just kind of an interesting study that really falls in line with our question today, or it's not going to answer the question today, but again, with the long-term trend still being up, is the downside over, or is this nothing more than a counter trend rally and a new decline? So this is it's not really as noisy as it looks, but let's start off with this table is based upon when the S&P 500 is below its 200-day moving average, and the CNN fear greed proxy is above 85 or greater. Essentially, what is the performance going forward? And they look back from 1998 to 2019. So this is about a 20-year snapshot. So I want you to look at the events when this happened, or the red dots when this occurred. So you can see several red dots occurred in the 2000 to 2003 50% decline. So the first three, when these took place, were very much near counter trend peaks, with the exception being the last one. It was near a counter trend peak, but obviously the market was much closer to lows than highs. Then we turn forward to the financial crisis, and we see a couple of times this occurred. One was right at the very first counter trend peak, and the other was when the market was embarking on the beginning of the 10-year rally that we've seen. So there's really two sets of numbers here, folks. I want to look first at the overall average. The thing that jumps out is when you put all of these performances together, 90 days later after these events took place, the S&P averaged a decline of 9%. 6 months out, it was down 8%. And a year later, it was down to 17%. But there's really a tale of two stories going on. So I started off talking about, see these three dots. These were peaks in counter trend rallies, and so was this one. So when you look at these red numbers, they're all correlated to those dots. But the dots that were close to the lows, this one that was close to the 03 low and the 09 low, you can see in the 03 low, a year later, the market had rallied almost 11%. And a year later, after the 09 low, it had rallied 41%. So that's why it's so important, folks, that we start looking at multiple tools to determine what is this red dot up here telling us. The first time a red dot took place in the 2003 decline, it was just a peak, and here we went lower, lower lows, lower lows, and lower lows. Same thing in the financial crisis. So this is the first time this has happened since the high took place on September the 21st. So overall, the numbers aren't pretty. They're not pretty whatsoever from a buy and hold basis. But you can see two different discrepancies of decent returns, positive returns, depending. So that, the question is the downturn over with, or are we staring right down the barrel of the peak of a counter trend rally? So a couple of things that we kind of sticking on the sentiment theme that we started sharing last year is that here's maybe an oxymoron, but when we see, first off, this is a chart from that I found on the internet, on Twitter, from Tio at atlasinvestor.com, and he does a great job of charting, and I've been watching his stuff for years. But we started sharing with all of you last year that the oxymoron is when you see on the news, we're doing well, the economy is doing well, and consumer confidence is high. I've tried to encourage every one of you to go read the book, The Extraordinary Popular Delusions and the Madness of Crowds by that Sir John, recommended to me. Gosh, why am I drawing a blank on that? I'll think of it while I'm talking here. But the bottom line is, when we hear high consumer, Charles McKay, excuse me, everybody, but when we see consumer confidence very high, that's actually a red flag. And when consumer confidence is bad, it's actually a good thing for buying opportunities. So as we debate the question, the long-term trend's still up, do we have a lot more to the upside? I want to kind of keep you in mind of where consumer confidence is on a big picture. We're looking back multiple decades, and you'll notice that the green highlights, let's just look when consumer confidence was low. You can see the early 1990s. I remember Sir John Templeton went on Wall Street Week with Louis Rukeyser, and we were in like 1993. And he said, Louis, I've just never seen some people so pessimistic. I really think some great things are going to be ahead. Well, lo and behold, we're right in the middle of the Iraq War. There was a decent reason for consumer confidence being low, but that was also a decent reason that stocks were at some good prices. Excuse me, this is when the probably the low took place that he was on TV, but the bottom line is consumer confidence being at a low was a good time to invest in the market. Look where consumer confidence was at the 03 low and the 09 low. But then on the flip side, when consumer confidence was high, look where the market was in 2000. Look where the market was in 2007. Now, again, folks, these are not, can you just look at consumer confidence and say it's high? Here's a great timing tool, and this is what I should do with my money. And I'd say no. But I don't think you can be an ostrich and stick your head in the sand and avoid this completely. So despite the decline that we've had of late, and 9-year support is still intact, consumer confidence is still at levels that historically the market has struggled moving much higher. And if you'll notice, despite the decline of late, we're still above 2007 confidence levels, and we're not too far off from the levels of 2000. So from a perspective piece, what would we love to see after the market's fallen hard is people being pessimistic and consumer confidence being low. And right now, consumer confidence, even though the market took the thumping, and even though we saw outflows being huge, consumer confidence is still at very lofty levels where markets have struggled to move much higher over the past few decades. And so is this just common in the United States? And the answer is heck no. So this is a look at the similar type of theme with European consumer confidence. And we all know that the world did worse than the S&P and the stocks last year. Europe struggled more, and Asia was much further down, and emerging markets were down further, and Brazil down further. It went on and on. But I still find it interesting that when the same thing applies, despite the struggles of last year in the European indices, consumer confidence remains closer to the 2007 and 2000 highs than it does the 2009, 2011, and the 1993 lows. So this thing could dip quite a bit further. And so this is to me, it's a concern that even though we're above 9-year support, I'd really love to see these things wrung out much more while long-term support is being tested. Another thing that I wanted to update, we've shared what the margin debt looks like. This is a different way to look at it from advisor perspectives and dshort.com. It twists the margin. It doesn't twist it, but it kind of renames it, or from a perspective on excess credit balances and negative credit balances. You know, the excess credit balance just means people got a bunch of cash and fuel to drive the market higher. Investors having a negative credit balance, folks, means nothing more than they got a boatload of money in margin debt. And so when this line is negative, that's when margin debt's high. So you can see how margin debt was high in 2000. And once this margin debt started to shrink, that's when the 2000 peak in stocks took place. And yet then when there was a lot of fuel out there, that's when the 03 lows took place. When margin debt, you know, when there was a lot of negative credit, in other words, margin debt was high, that's when the 07 peak took place. And then lo and behold, look at the cash levels at the bottom of the financial crisis. That was a boatload of fuel. And that fuel is what has propelled us over the last 10 years. But what I've tried to advocate, something that I've just noticed on the surface, is that margin debt being lofty in and of itself is not bearish, but where the trigger comes of concerns is when margin debt is big, or in other words, negative credit balance is low and it starts shrinking. In other words, people say, I think I better get rid of some of this margin debt. I'm taking a thumping. You know, I was long whatever positions it were on margin stuff. I'm losing my tail. I got to pay off some of that debt. And when that shrinkage starts taking place, that's oftentimes when long-term trends come to an end or can really get hit hard. So the top blue line's the S&P, and we all know that it went down. But you'll notice in the last few months, negative credit balances, or in other words, margin debt is actually shrinking. So that's a concern on a larger picture, or from a larger time frame. Another thing from a valuation perspective, this is the Buffett indicator, which is corporate equities, the value of all corporate equities divided by our economy, or gross domestic product. I like this chart, 6-7 decades in length. It's not you don't want to use it as a timing tool, you want to use it as a perspective tool. And so, you know, one of the things, if you're a student of the markets long term, you'll notice that the highest that this indicator had hit ever in its first 15 years of being in the business was 1965, and the Dow, it doesn't show in this chart, everyone, was at 1,000. So 15 years later, the Dow was at 1,000, but now this valuation had almost declined 2/3, well over 50%. It went from an 87 reading down to 32. And this is where the great bull market, so like I said, the Dow was at 1,065, it was at 1,082, and it didn't look back. But this was the 2000 level at 161. Here's the 2007 level, just to give perspective. So other than the last year of the 2000s, we're as high as we've ever been in the history of this indicator. And so, as I've said many times, folks, this indicator does not mean that a top is in play. This indicator does not mean that the market can't go higher. But to me, the power of this chart is to share perspective that so far in the last 6 decades, no long-term bull market of 3 to 5 to 10 years has ever gotten started from these levels. And so that's the perspective to take away. Doesn't mean to go to cash, and it doesn't mean to short right here, but it does mean to empower you that don't be surprised if markets can struggle, or you want to know where the exit door is if further selling takes place, or if that 9-year rising support is broken. This is another one that's kind of busy, but just hang with me, folks. It's one of the ones that Sir John Templeton shared with me in the very late 90s. If you're not familiar, I thought I was unlucky at the time, but in hindsight, I was just blessed that Sir John said, Chris, there's at least like 10 reasons, this is in the very late 90s, there's a multitude of reasons why I think the market at best will be flat for 10 to 15 years going forward. And this was one of them. So let's just walk through this chart a little bit. And the first off, this chart's based upon the gray line. And the gray line is the percentage of U.S. assets in stocks. See, it says U.S. household equity holdings. And so that scale is on the left side. So not too long, we just talked about the mid 60s. So you'll see in the mid 60s that the average household had between 40 up to almost 45% of their assets in stocks. And then we just mentioned a minute ago the early 80s. And you can see by the early 80s, I mean, the Dow was at 1,000 here, everyone, in the mid 60s. Then the Dow was still at 1,000 in the early 80s. But what a flip, that almost 45% of the average household were exposed to stocks. And then by the early 80s, when people were pessimistic, it had fallen to nearly 20%. So it was one of the lowest exposures in the last 60 years. So where are we now? But before we look at that, you can see the 1999-2000 level is about 50% of household assets were in stocks at the 2000 high. You can see where it was in the 2007 high was about at the 42% level, which was about the level in the 1965. And then here we are now. So you can take this and look over here to the left side. We're about at the 45% level. The neat thing I like about this chart, it's an overlay, and the red line then is what was the 10-year return after household assets were at any certain level. So let's just go back to the early 90s. And so when very few assets were in stocks, this indicator at that time would have been projecting that stocks in the early 90s should average 19% a year for the next 10 years. And lo and behold, they averaged like 20% a year for the entire decade of the 90s. So this puppy was spot on. And when you think about in 1965, when 45% of household assets, it was projecting, if you take where the gray line is and you look to the right, it was saying the S&P should gain about 2% a year for 10 years. And it was spot on. So here's what it's suggesting at the 09 low. It was suggesting what, everyone, if you look at the gray line. So the gray line in the 09 low, what was it saying? Stocks ought to average around what? 16% a year for the next 10 years. And they've been a little short of that, but still around 14%, not bad. So the thing that I want to empower you with right now, where's the indicator? It's 45% of the average household's holdings are in stocks. And this indicator is suggesting from a buy and hold basis that the S&P ought to make about, on average, 2% from now till 2029, 10 years from now. So all this would say is, again, like the prior chart, it doesn't mean that the current trend has to go down. It doesn't say go short at current levels. You know, let's let price determine that. But it does say that those people that are investing passively, and that's been the biggest theme over the last several years, is passive, passive, passive. You know, John Bogle's been right for many years, the founder of Vanguard, bless his heart, rest in peace. One of the greatest benefactors to all of us as investors was the creation of his products. But what this would say is, from a historical perspective, is that those Vanguard funds that have low costs will have low returns on average about 10 years out from the U.S. indices. So let's see, everybody. Let's get back on the line about 10 years from now. We'll see if this chart's been right. But thanks for letting me walk through this one, because this has been one that really meant a lot to me today, because this was shared with me at the highs 20 years ago, and it was just razor sharp, spot on. And it's been very spot on for decades. So to me, it remains important, the message today. So as we shared in last week's sector report, this is the monthly returns over the last 10 years on the S&P 500. And the one thing that I wanted to highlight, if we would have any type of seasonality, if these counter trend rallies continue, this would be a good window for it to happen, because over the last 10 years, the 90 days from February 1st, from February, March, and through April have been the best 90-day window of the entire year. And as I said in the report, man or woman shouldn't invest on seasonality alone, but I also don't think we should stick our head in the sand and say this isn't meaningful. I think the combination of seasonality and price is the answer for us. But I want to continue to make you aware of this is a positive seasonal window that takes place. And with those outflows being massive, it could be a fit into this seasonality study. So I do believe that with the 261 extension level still being the 800-pound gorilla, I don't know, folks, if it's 7% above current levels. Forgive me for not knowing the exact number, but until broken, to me that remains very heavy resistance. And so if there's money to be made, I would favor that the money's going to be made in some individual stocks that have seasonality, positive patterns, and positive price action, more so than just the indices themselves. So this is just a reminder that the median return in February is 3.3% over the last 10 years. And then these are the 20 stocks that have done in the S&P 500 that have done the best over the month of February over the last 10 years. So these are some of the ones I'm going to look to for the combination of seasonality and positive patterns or breakouts. One of the ones that we hopped on just recently was CDNS. Its average gain in the past prior 10 Februaries was 9%. Probably one of the more favorable patterns out there that is really hard to find anywhere. It's the pattern that we played 70% plus in the calendar year 2017. It's my favorite pattern in a rising market, and it's the bullish ascending triangle. The bullish ascending triangle is characterized by a series of flat tops and rising bottoms, and then once the flat tops are taken out, they tend to attract buyers. 2/3 of the time this pattern pushes to the upside, and you can also use a measured move calculation. So as the combination of seasonality and CDNS was breaking out, we recently purchased it. As I sent a message today, we got some gains so far at early in this week. We're just 2 days under our belts. There's it really shot up yesterday and backed off being Monday. So there's a little bit of a bearish wick up there that is not what you'd like to see. One of the ideal patterns would be for it to come back down and kiss old resistance is new support and for it to take off. That doesn't have to happen, but I did raise the stop to pretty much the top of the bullish ascending triangle, that if this would be a failure move and it would break down below it, I think we'd have maybe a 75 basis point loss in the position. So it'd be very small if it reversed and went lower. Another breakout from a February strong seasonal stock. This is AKAM. That's median gain in February over the last 10 years has been 9%. Looks to be a bullish ascending triangle taking place, a bullish falling wedge taking place, and there's an attempt to break out to the upside. And so we've purchased it based upon the breakout, and then the red line as we put a stop just below what would be new support. If it happened to come back and take that out, the position would be closed. So one of the things that as we in church and oftentimes the messengers say, well, in wrapping up, and all of a sudden that's when everybody perks up. I think this is an area, folks, we ought to perk up to, and it's that this compares the top line as United States stocks, the middle is European stocks, and the bottom is Asian. And you can see really easily, folks, the bearish divergences that took place is when America peaked in January, February, so did Europe and Asia. But then what happened there is they just started creating a series of lower highs and lower lows in Asia and Europe. But the United States, moved and created a slightly higher high into the fall of this year. So a bearish divergence took place. Sometime in the middle of last year, I showed a catch-up bottle, and I said, to me, the proverbial question is, what type of game of catch-up is going to take place? Are the hard-hit European and Asian stocks going to catch up with America and be pulled up to the upside, or is America going to catch up with Europe and Asia to the downside? And now we know that the catch-up game was America caught up with those two lagging indicators on the downside. But these indices are much harder hit and could prevent or provide some opportunities. One of the ones that we share every week in the Global Dashboards report is the message so far that continues to come from the DAX index. This is a look back over, 25 years in the DAX index. And since the '03 low, the DAX index has created a series of higher lows and higher lows and higher lows along line one. The decline last year in Germany brought it down to test this long-term support line and the bottom of the rising channel that's taken place over the last 8 years. And you'll notice any time that relative momentum was oversold as it tested this long-term support line, it was actually a good time to buy the DAX or to be an owner of it. And so as I posed this week on the blog, so goes the DAX, so goes the S&P. It's not as simple as that, but the DAX can send the S&P and stocks in the States a really important message. And so this is another one, folks, that from a long-term trend, the long-term trend did not get broken going into Christmas. It hit triple support, and so far it has held as momentum is the most oversold, or it hit the lowest level since the '09 low. So the DAX could go a long way in resolving the question, is this a counter trend rally and a new downtrend, or is the long-term trend run its course to the downside, and now we're going to start higher prices? So we're going to continue every week to watch, and I'd encourage you to watch the DAX closely. But one of the things that's been so out of favor that it's time for it to come back into favor. This is nothing more, folks, than a ratio of emerging markets to the S&P 500 or stocks in the States. And you'll see that emerging stocks going into the mid-90s were much, much stronger than stocks in the States. And then they fell from 1994 for 5 to 6, 7 years. And then, so in other words, when this fell, it was a time to own U.S. stocks and avoid emerging. Then from the '09 low through the commodity high in 2011, emerging outperformed again, much stronger than the U.S. stocks. Then after commodities peaked, gold peaked in 2011, the franc peaked in 2011, then emerging markets have declined now for a lot of years. So this could be somewhere along the line, especially that this low has taken place in this blue circle, has been down here for almost 3 years. You can see that emerging markets haven't been much weaker than the S&P for several years. So folks, if there was a place to say, if you could put some money in an envelope anywhere in the world for 5 years from now, and you were forced to buy and hold, this would be a decent argument to say this trend that's been going down now for 9 years, it's still going down, but it's definitely from a time perspective has run into extremes. So we're really going to keep our eye open on emerging markets. We're going to keep our eye open on EFA. We're going to keep our eye open on CQQQ, which is the China ETF, all due to just how much underperformance they've done with America for several years. And so one of the final tells and charts in today to me is interest rates. And this is the yield on the 10-year note going back into the 80s. And you'll notice, I'm not telling you or showing you anything new, interest rates have created a lower high for several decades. And we tried to make the case last year that if rates would hit resistance and fall off, my take was that would be bad for stocks, that actually rising rates weren't so bad for stocks. The Fed, there was a lot of concern that the Fed was raising rates, too much or whatever. But you'll notice when this resistance line was nearly touched in 2000, then it was touched in 2007. That's when stocks and yields both fell apart. That's when the S&P fell 50% on 2 different occasions. So we're back testing this resistance line last fall. So this does not surprise me to see yields backing off as stocks did. So one of the big tells, if I could just look at one chart to answer the question, is this a counter trend rally or is the long-term trend still in effect? It's going to be what the 10-year yield does at current levels, which is around 2.7%, a little bit below that. at this price point, number one, that if the 10-year yield, if you would see its break support here, to me, the odds would increase that we are in the counter trend rally mode, and that a peak in stocks is very close at hand. So the opposite tell is that is if the long-term, the 9-year support is going to hold, and if we have a chance of breaking above the those key Fibonacci extension levels, the 261 extension levels of last year's highs, I think we want to see rates actually rally and break out above the highs of last October. So I want to appreciate or share my appreciation to everybody, all of your membership. It's been, to me, a very rewarding past year, despite some of its challenges, because to me, that's when we can make some of our biggest benefits, is trying to, as we suggested, capital preservation, and so many assets really struggled last year. So as I said, I'm starting my 39th year, and I'm just as excited as I've ever been in my entire career. And again, I'm humbled by your membership, and appreciate all of you very much. So I hope you have a great February. Happy Valentine's Day to the loves of your lives and your families next week. Don't forget it, guys. It's an important day. So until next month, appreciate you. Thank you very much.